The next problem we are solving is question 5, and it is on the preparation of a balance sheet of Lakshmi Bank Limited as of 31st March 2020. Okay. So, in this problem we will not be given any profit and loss related items. We will be provided with balance sheet items that we are supposed to
Hello,
put.
teacher.
Yes.
Teacher, did you call us?
So, these are all debit and credit balances that come into the balance sheet either on the liability or the asset side. Only a few things related to profits are given to you, which we are going to use to calculate the profit balance. Okay, and accordingly calculate what is the balance of that profit that needs to be carried forward to the balance sheet. Other than that, all of these other items are such that they appear only in the balance sheet and nowhere in the profit and loss account. Okay, so a few different things we are going to learn here in context of the balance sheet, and for that, in order to identify where all of these items belong, we will try to look at the pro forma of the balance sheet as we do this problem. Okay, so below the second half, I will show you all the question, that is question 5. Okay, we will solve these items one by one and we will decide which of the headings or which of the items under the balance sheet they are going to go. Over here, I will show you the pro forma which I have already sent you. It's available with you all. This was the P&L that we've done, and this is the pro forma of the balance sheet. Okay, so let's see. So the balance sheet is prepared in case of banking companies in something called a Form A. It's called a Form A, the format of the balance sheet, and accordingly you have to write it as balance sheet of so and so bank as on so and so date. Now it's very similar to the type of balance sheets we have seen for manufacturing industries or manufacturing sector and all other type of companies, but with a few changes. Capital reserves and surplus remains the same. We all have that. Only two things that are additional in the liabilities are deposits and borrowings. Now do not get confused with these two terms. Deposits for a bank mean all the money that people have deposited with them, correct? So it's like a liability. People have given them the money, they have to keep the money on behalf of their customers, their clients, and they have to pay interest on that money. So those deposits become their liabilities, and that's schedule 3 for you. Okay, what are borrowings? Now again, these borrowings are not loans which they have given. These borrowings are loans which they have taken. Like I told you, banks also take loans. They take loans from other banks. They take loans from the RBI, right? So these are those borrowings which become liabilities for the bank. And of course, there are other liabilities, any other provisions like income tax provision, proposed dividend provision, and all other sorts of liabilities in the form of outstanding expenses and everything will come over here. So that's our liability side. Next we have the asset side, that is cash in hand and balance with RBI. This is a little different from other balance sheets that we normally solve. So for a bank, the asset will be the cash with which it holds by itself on a day-to-day basis, and also the cash balance that it keeps as reserve with RBI. We know that there is something called a cash reserve ratio. Some part of all the cash which is held by the bank, certain percentage has to be maintained with RBI, and that amount cannot be given in the form of loans. Okay. Then maybe the bank has given some money to other banks. So balance with other banks, money at call, money at short notice, these are different ways in which banks provide money for each other, right, to meet their short term shortages. Like, so if the bank has shortage of funds to a certain extent, it may take money at call or money at short notice from other banks. So these the balance with other banks which is given is what the bank has kept with other banks, right? So they are like advances given, they are like loans given to others, so they are assets. Then we have advances. First is investments, that is schedule 8. This may have moved just a little bit. Schedule 8 is investments. So any form of investments that the bank has in the shares, securities of other companies, any other type of marketable instruments, those investments are assets. Next is advances. Like I said, when the banks provide loans, they are called advances and they are assets. But when the banks take loans, those are called borrowings and they are liabilities, right? And of course, we have other types of assets and fixed assets, all the fixed assets of the bank. Now, Schedule 12 and this other information called bills for collection, it doesn't really form part of either the assets or the liabilities, but it is still to be shown in the balance sheet somewhere, right? As we do the problem, we will see what type of items fall under these two categories. For now, we will move on to this problem that we are doing and accordingly classify all of these debit and credit balances that were given under each one of these schedules. So, I am keeping the pro forma here for you all so that you may look at it and you may tell me where each one of these items belong. So, understand, over here the liabilities are given first, that is all the credit balances are given first, and assets which are debit balances are given later, alright. So, in the problem debit balances are provided first. So, accordingly you tell me where each one of these are going to come, okay. So, first one, cash credits, and we will note them down as we are doing it. Okay. Can you all tell me where will the first one come? Cash credits, it's a debit balance. Where will we have cash credits? All these debit balances will go under assets, alright, they are all assets, and in this case cash credits basically mean a type of short term loan that is given. Like a lot of businesses, they take short term loans for their working capital needs and these are called cash credits. So, cash credit is a type of loan given. The moment it is debit balance, you know that it is a loan given, alright, it is an asset. So, cash credits is going to go under advances, which is schedule 9. Next, cash in hand, what is the schedule number? I hope you all can see the pro forma on top. I have kept it right there for you to view and tell me which schedules it will go under. Just unmute and speak. Where does cash in hand go?
6. Schedule 6.
In schedule 6. Very good. The very first item under the assets, cash in hand and balance with RBI. Very good. Next is cash with Reserve Bank. Again, a debit balance under schedule 6, balance with RBI. Cash with other banks, where will that come?
7.
It will be under balances with banks, that is schedule 7. Money at call and short notice, also schedule 7, right? Yes, it's schedule 7. Then there is gold of 82.84. Where will this come? Under which of these categories? We already know it's an asset, it's a debit balance. So, where will gold come? We have something called investments, am I right? So, a bank can invest in gold, right? Physical gold, or it can invest in gold mutual funds or anything like that. So, gold in case of banks is an investment. So, schedule 8. Same way government securities. Government securities are what the bank has invested in, right? They have put money into government securities. So, you have schedule 8. Like you may know that RBI, it asks banks to purchase government securities sometimes, or the public sector banks, they purchase a lot of government securities and so on. Then next you have is current accounts. Where will this come? Current accounts with a debit balance. Where will this amount come? Yes? See, normally, what do we mean by current accounts? If you know the concept, current account is all those type of accounts which business people open with the bank, right? Now, current account is like a deposit that you make with the bank. You deposit some money in the current account, isn't it? Now, any type of deposits are technically liabilities for banks, isn't it? So, why is this current account of 42, okay, 42,000 rupees shown as a debit balance? Yes, are you understanding the concept that I am giving? So, let us say, I will just try to make it more clear and try to, give you a picture of what exactly I am saying. So, let us say you have deposits, alright. This is the bank, this is the client, alright. We know our basic theory by now. When any deposits are given, and deposits can be in the form of savings account or current account, right. So, all types of deposits are for the bank, those deposits are liabilities, alright. They will come under the liability side. Whereas, if the bank is giving some loans to the business or to the clients, it is going to come under the asset side, that is advances, correct, schedule 9. So, if current account is actually a liability, please understand that liabilities are all credit balances, assets are all debit balances. So, if current account is a liability, why is this current account showing you a debit balance? Why is it put under debit balances? Can anyone tell me that? We also have, if you look at the problem, you also have current accounts with a credit balance again, right. So, this is correct. Technically speaking, this is correct because current accounts are supposed to have a credit balance. They are a liability, but there is this current account with rupees 42 as a 42,000 of course as a debit balance. Why is that? Is everybody aware of something called an overdrawing facility of the current account? For example, if you as the client has rupees 10,000 in your bank's current account, okay, this is your current account and you have put 10,000 in it. For the bank, this 10,000 is a liability, okay, it has a credit balance because you deposited it with the bank. So, for them it is a liability. But what happens is, on current accounts there is a very special facility that is given. The clients or customers can overdraw, they have an overdrawing facility. So, even if you have kept rupees 10,000, you can overdraw, let us say rupees 15,000. You do not have 15,000 in the current account, you have only 10, but you can overdraw, you can remove more than what you have, right. So, what happens in that case? This balance 5,000 that you have taken becomes a type of a loan that the bank has given you, and when banks give you loans, those loans become a debit balance, they become an asset or advance for the bank. Have you followed? So, you deposited 10,000, okay, that became a liability for the bank. but you took 5,000 extra, that became an advance or an asset for the bank because they gave you that loan. Is this clear? So all current accounts which have this debit balance, we in other words call them overdraft. Whenever a current account is given with a debit balance, it's an overdraft, and overdrafts are treated like loans which go under advances. Is this clear? So advances is schedule 9. Then you have premises. Of course, they are fixed assets, furniture is fixed assets, and term loans are again type of loans. So advances, and they will go under schedule 9.